and welcome to Options Guide TV. My name is Brian Overby. I am the author of The Options Playbook and your host for 25 minutes here. That's what my guest is going to be on Options Guide TV. All right, so markets are finally getting a little scary. So we're now back to AI bad, AI spend bad. I guess that's the way I would say it, because the market seems to ebb and flow in that direction. First off, we have there's not enough money that you can spend. Anything you're spending on AI is going to drive the stocks up. And then DeepSeek came out, and then everybody that's making all this spend, well, you guys are idiots, and we're going to sell all your stock because you're spending too much money. But then they came back and said, well, gosh, they're still spending. Why are they still spending? Well, this must be a good thing. And then all of it went all the way back up. Now the markets are basically saying, well, you're going to have to make, not only are you making the spend now, you may have to make this over and over again as NVIDIA comes out with new chips. And now you're dumb for making the spend again. And that has happened. So what's going on with the economy is not driving the market. I mean, that's a strong phrase. What's going on with AI is what's stabilizing the market. And if people are spending because of AI, the market seems to go up. And if they're not spending, or they're getting trepidatious on their spending and their direction, then the market seems to go down. And the Meg 7 are, propping up the whole market. We have NVIDIA announcing earnings on Wednesday. And I kind of feel like the markets need NVIDIA just to announce, just to move on with their lives, right? Like NVIDIA is always the last of the Meg 7 of all the mega cap tech stocks that, and it should be the first, is kind of the way that I feel. But everybody's waiting. They're announcing on Wednesday after the close. We'll look on a trade on Wednesday in NVIDIA. We'll do a speculative short-term play on NVIDIA. And then we are, and then a couple of stocks that I want to look at today, and one that I've actually, been bullish on for a long time, and just kind of happy to see that it has finally really started to take off is Google/Alphabet. So I'm going to look at a trade in Google/Alphabet. That's going to happen too today. And then I want to go and then we'll look at our two trades that we set up on Friday. So 1 second here. And we see the VIX actually kind of popping a little bit, just to add a little bit of more weirdness to the market and what's happening. Like this type of move, well, we're not really going anywhere. So it's not like it's a huge down move. Everybody's been calling for a 10% correction for quite some time. The Fed's really confused as to what they're going to do. It's fluttering between 40 and 50% chance that there will be a rate cut at the next Fed meeting. And, unemployment, AI is happening. And a lot of companies don't, if you ever talk to them, a lot of them will say, well, AI isn't cutting jobs. Well, guess what? They're cutting jobs. And it's very obvious that there are a lot of jobs that are being cut. And AI has a lot to do. The customer service jobs, they say, well, they're going to make their jobs easier. They're going to make this. The bottom line is they just don't need as much workers. And the AI is happening. So to me, in general, it's a scary scenario and unprecedented times. Who knows exactly what's going to happen? Markets are, no matter what's going on around the world, stocks are going to do well. They're going to have better earnings. And who knows what the multiple should be at this point in time. But, we have the VIX trading up around the 20 level. Like markets are at all-time highs, and we got the VIX trading around 20% implied volatility going out the next 30 days. So, yeah, like I said, kind of a weird market. Now, so what can we do in the option space? Well, Lockheed Martin is one of the stocks that we looked at, and that stock is up. And then we looked at Freeport-McMoRan, which is a mining company, and that stock is down. But this is one of the only stocks that is up in the marketplace. They got beat up mainly because of the government shutdown. And I guess people are thinking that we're going to be okay now that the government has opened up, or at least kicked the can down the road, which is very true because they still can't seem to do uh, a longer term outlook as far as the budget is concerned for the U.S. government. So we still have that situation. But Lockheed Martin up today. Here's the trade that we have on, and I like this trade, and I liked it. As soon as the government opened back up, we're looking at. We got it. Well, let me do the what if calculator. Let's go there. And Lockheed Martin. I didn't send it there. So let's send it. We have it here. And this is known as a diagonal. Inside the playbook, I actually call it the fig leaf. How come you're not showing up? Don't do this to me again. We had a rough time on Friday trying to make things work. It seems to really drag as soon as we get the StreamYard up and running. And I have all new equipment, so it doesn't make sense, but we're dragging again, it looks like. All right, well, I'll stay on this tray. It doesn't want to send it there. All right. So our longer term option is the January 16th, 2026, which is 60 days away. And we're buying the 440 strike call. We were targeting an 80 delta. So the delta was at 80 when we put on the trade on Friday. See if I can at least get the charts to come up. Okay, there we go. And let's zoom back down on in here. And I love the fact that we came up and we've now closed above the 200-day moving average. This is a golden cross. Well, this was actually a death cross right here. We had a 20-day crossing over the 50-day. This was before the government shutdown. Kind of had a flat day, and then we're finally getting some momentum to come back in. Breaking above the 200-day, we'd like to see this start turning and going back on the 20-day moving average. Let's go back 1,000 here. But we're finally seeing a little bit of strength in the market. Right here is the press, right in the middle of this noise is about 470, and we're at about 478 right here, because you see we got a lot of consolidation in this area, and then it took off. Now we're back, got a lot of consolidation, and then we dropped, came back strong all the way through. Government shut down, started coming out. This would have been September 29th, about beginning of October is when the government shut down. It extends, contractors aren't getting paid, end up here, and now we're back into this area that has been a very interesting area of support and resistance through here, through here, through here, through here, through here. So if we break above the 470 range, then I really like to get even more bullish on Lockheed at that point in time. Maybe we're going to go all the way back to where they were trading after their last quarterly earnings reports, what was fairly strong. Now, we have an issue with quotations that we sold a near-term option against it. We're still not moving. Send to the what if. All right. And if I go on the short term and we look at the 28th, which is only 4 days away, we sold the 485. So this position is fighting us, right? We sold it because we were, on the government had just opened up. The government hadn't really, or the investors of the market hadn't really decided, is Lockheed Martin going to get everything back? Are they going to get paid? How are things going to happen here now that the government is opened up? But we're talking about millions and millions and billions of dollars that weren't getting paid out to government contractors, billions of dollars. And so in this instance, now the marketplace seems to be getting a little bit more comfortable with it. We're at 467.50, 468 right now, 485. So we still look pretty good. The 28th is when that expires, which is 11 days away. 485. I think it's going to have a tough breaking through the 480 level. That's right. We looked at that. 480 was a resistance to the upside. So we did the 485. And this is now trading for, we'll call it $2. Call it $2. And time decay is going to really start kicking in. So I like the setup of the trade, looking at what we did on Friday, all the rationale that's behind it. Now we kind of see some of that momentum. If we break up towards the 480 level, I wouldn't even mind just getting along another option if you wanted to. We bought a deep in the money option as a surrogate. You could even speculate a little bit more on a shorter term move using a shorter term option. We went out 60 days. We'll probably take this trade off at least 45 days. That's when I would wipe the trade out. I would either roll the option contract up or just close it out totally. I don't mind selling this. I don't know if we'll sell another one though after it expires, because that kind of little area that we were nervous about that this was giving us some protection for, we're not as worried about now. Okay, so now I see my screen is moving up here. I can probably send this to the what if calculator. Nope. All right, I'm going to give up. All right, now let's go and look at the FCX Butterfly. Here's the trade that we have on. The market is, well, now I got to send this down below. FCX is down a little bit today. The trade's down a little bit today. We put it on for about 65 cents. It's trading for about 50 cents. And now it's 38 cents. So market is down even more. It's down 93 cents on the day. We have a lot of time on this trade. We put it on for 65. We're about cut in half. So if you wanted to get out of the trade, you could. But if I look at this trade that I put on for 67 cents or 65 cents, somewhere in there, I usually going to treat it as it's an all or nothing trade. If the market does go up above and closes above the 47 line, well, the maximum we can make then is a quarter, but we don't lose if it goes higher. Right here at the midpoint of this trade, you're talking the most that it could trade for would be $3. $3 minus the 65 cents that we paid for it, just to make the math a little bit easier, would be $2 and 35 cents. That's our max upside that we can make on the trade if we did that. Yeah, I'd just let it ride. I'd let it ride. Looking at the chart, there's a lot of fluctuations in this area. Price of gold obviously matters. GLD right now is down a little bit today, and I don't know necessarily why it fluctuates so much with the price of the gold and the metals. I can understand that it will move, because they're mining these metals, but they're still at all-time highs. So they're still making amazing profits on anything that they pull out of the ground. So the companies should be a little bit insulated, but I guess I get it. If we see gold right now is down 0.5%, but we see that Freeport-McMoRan is down 2.5%. All right, now Google. Berkshire Hathaway came out and announced that they have a fairly small position in Google for them, but it wasn't really on the bingo card, if you will, as far as people were considering what Berkshire Hathaway would be investing in. And Google has done well since. And you see the down market, you see a lot of red over here on the watch list, but you do see Google sticking out as a solid performer in this range. So with that said, you have Google at 287, 64. And I wouldn't mind. It still trades at about 28 times. Interesting. Somebody mentioned that as far as forward earnings are concerned, and I didn't have the hard numbers, but mentioned that now Meta is trading below the valuation of Google. And Meta, that just kind of shows you how bad Meta's been beat up and the disrespect that they're getting, mainly because of the spend and the type of money that they're laying out for the AI. Zuckerberg has done this before. He's gotten beaten up before and stock came back. Now, once again, the scenario that I painted at the beginning, Meta is the, in the dictionary, Meta is the picture that's next to that scenario. So let's look at Google. Google and Apple. Apple is actually beat up a little bit today too, but Apple, it turns out the fact that they're not spending now, a lot of people are like, well, maybe they were smart. Maybe this is the way to go. They are spending. They're just not spending exorbitant amounts like all the other companies that are out there, and they were getting beaten up for that. Same, they're behind the grade, and that's when their stock was at 200. Now it's at 266, but that's down today. But I don't mind getting long some Apple either. Okay, so let's do Google, and let's do the same type of trade that we just did in Lockheed Martin. I'm going to sell something near term, try to bring in some of that volatility. Earnings are done. Now, I guess we could wait. If you're nervous, you wait until NVIDIA's earnings. Same thing that I'm saying in that earlier I mentioned the marketplace always seems to want to wait for NVIDIA to announce earnings before the market can decide where it wants to go. Everybody's hanging on that earnings event. But I'm going to do Google. Google is probably one of my biggest holdings. I've had it for a long, long time in my own portfolio. And I don't mind getting long a longer term option. So let's go out to February. We're going to even go out further than the 60-day level. We're going to go out to February. And part of the reason why is that when we looked at Lockheed Martin, that stock is like a $465 stock. So that option contract, we usually kind of just look at one option as a surrogate for the stock on the show. We don't try to get too egregious on capital, and that option contract was reasonable because we did a little bit shorter term option. I'd prefer to go 90 days out on these. Anywhere between 3 months and 6 months is about the range when I'm trying to buy a stock substitute. It's where I like to be. Inside the playbook, it actually talks about leap options, which go out 9 months in time, and I'm okay with that. But it's got to be on the right underlying. Google is maybe a stock that you could do that on. $285. You could buy a few of them as a substitute to owning stock. So if you obviously bought 100 shares, you're talking about $28,743 is what it would be to buy 100 shares of stock based off the price right this instance. I still see the upside. I don't think that, you hate to buy something on a 4% update, but we're going to be longer term on this one. We're going to hang out with it, and we're going to sell some calls against it on the short term. Okay, so I don't want to miss out on an opportunity. 80 delta right here, 48 by 47. We can go down to 44. Yeah, let's do the 77 delta. 70. So this acts like 77 shares of stock. We're going to buy this one. And we're going to then sell something short-term against it. So in this instance, we're talking about a $44 option going out to 95 days to the February 20th expiration. We're buying a 77 delta. And then let's go and let's look at, we're going to decide between November 28th and December 18th. It's going to be a little bit more about the premium. And we're going to go at least a 1 standard deviation move out of the money. Yeah, we're getting enough here on the 11-day that I don't mind doing the 11-day. We could go up to the 310 level. Let's pull up the chart on Google. I think we're at all-time highs, though. 3, yeah, we're beyond that. 285. Let's pull out. Yeah, we got 1,000 days. I think we could do the three. We could even go down a little bit more. 280. Yeah. A lot of noise right here at 291. And we're hanging right there. All right. So let's do the 305. 18% chance of it reaching. This is the one we're going to sell. Okay. See if this will work. Here we go. I'm going to try again. Fingers crossed. All right. Don't think I like that other chain. So this looks a lot like a covered call, but it's not. It's a fig leaf. Inside my book, it's called the fig leaf. Optionsplaybook.com. If you go and check it out, it's called the fig leaf. And I always say it that it's like a covered call, but it's not. You don't own the stock. So you got to manage this trade. You own something that looks like the stock. It looks like 77 shares of stock based off of the delta that's in the option contract, but it's not the stock. And because of that, you have if you do get close to this strike, you got to do something. You don't want to be assigned and have to buy the stock. Now you can, and you would lock in a capital loss actually, because you'd be buying the stock via the assignment. You don't exercise the call. That's one thing that you can do. But then again, we're not here to give tax advice, so it's not meant to be a recommendation. And then the 255 call, the only way that you ever want to exercise that is if there's no time premium, and there's gonna be time premium in it. So you just don't want to be assigned, and that's why I call it a fig leaf, is because you're kind of covered. You're covered, but you don't have the stock. And if you do get assigned, you got to figure it out. And so it's not for the covered call trader that can just set it and forget it. You got to watch this position, and it gives you something similar to a covered call, but there's the reason why there's no hard lines or curves that is kind of curvy is because we're using options with different expirations. All right, but it draws a real nice profit and loss graph here. All right, so we're starting to get a little bit long the market on stocks that we like. Google, we did a short-term speculative trade on the mining company, but Lockheed Martin, like that stock long-term, I think it got beat way too beaten up relative. I mean, obviously the government shutdown continues. There's still going to be some headwinds, and it's going to get mentioned in their next quarterly earnings report. That's going to get talked about. But that's where we're at. All right. Any questions? We're at 25 minutes. That's pretty good. I called that for the over under on a fig to use simple numbers. If I buy 100 strike call for 5 as the long leg. Okay, there we go. Here's from Doug. If I buy 100 strike call for 5 as the long leg, I typically would sell the shorter term one with a strike less than 105. Am I being too conservative? No, I don't think, Doug, I don't think you can be too conservative on the strikes. Like, to me, I feel like this Google trade that we just looked at, this might be a little bit aggressive. Right? We're selling right at the 1 standard deviation move. We're bringing in a good amount, but I look at the chart and we're a little bit frothy, right? It's going to 300 is right here, and there's a lot of noise. If we do break out about, we touched above, but I like to err on the side of being conservative. If I am selling against an asset that, first of all, I'm not paying as much as I would if I bought the stock out. I'm paying a fraction, about anywhere from 10 to 15% of what it would cost me to buy the underlying stock outright. So I don't need to bring in as much premium. And I have a headwind in that if I do get pegged on my short call option, I got to do something. So I'd rather err to the side of either doing a shorter term option with that strike and give up premium, or go a little bit longer term and go further out of the money and give up some premium. I'm willing to give up premium as part of a fig leaf, where I'm not as willing to do that on an actual covered call position. And that's the way that I would always approach it. So I'm going to err to the side. I really, really, really don't want to be assigned. But with that said, too, $1.70 on this 305 call Well, that's a big deal on a $42 option, right? On a percentage basis, you're bringing in a real good premium relative to what you're paying for that option contract. I got a little bit of a head cold, so I'm struggling here today. Where did we go? We went out 95 days. Okay, so right here. So this is a $44 option, and we're bringing in $1.75, right? Well, at that moment, it was $1.75 on 44.50, we'll say. Yeah, we're bringing in 4%. Like, think of that as a dividend on a stock. Like, that's a huge amount of premium that you're bringing in on your $44 investment. So do I mind making that 2% and selling the further out of the money option contract? Yeah, no problem with that. 305. So, I don't mind selling the 310 here. And you're bringing in $1. That's all right with me too. And if it's your first time doing the fig leaf, I would do the 310. But I would see. So in this position, if it gets close to, if it hits 305, something's going to happen in my portfolio. If I have this position on and I have a fig leaf on and the market hits 305, at that moment, I'm going to roll. I'm not going to let it get to 310. I'm going to roll before it gets there. So as soon as it hits 305, either I'm going to roll or I'm going to close out the entire position because I will have a gain on it. And that is what's going to happen. I'm not going to let it go beyond 305 before I roll. If you get to 310, 312, 315, it's going to be almost impossible to roll and get it done for a decent net credit to the account. And there is a section about rolling options in my book too. And I'm on my website, optionsplaybook.com. All right, that's it. We're right at 11:30. Thank you for stopping in. I guess this Wednesday, oh gosh, we won't have a show Wednesday. Well, okay, so inside the Tradier YouTube platform, you're going to start seeing some shorts. This Wednesday, I will do a short on NVIDIA on a trade. It will be a speculative trade, probably a butterfly, maybe open wing, maybe skip strike, but we won't have a Wednesday show because of that. And we're going to keep doing that until we get told not to. And then on Friday, we'll come back and have our next show. But yeah, I'm kind of sad not to have a show on Wednesday. See if I can pull that off. Click subscribe, ring the bell, get all the alerts, and hopefully we'll actually have a show on Wednesday. All right. Thank you, everyone.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.